Hello, Farm and Ranch Management. So 3 things today, all about the income statement. So Chapter 5 is the income statement, and its sole purpose is to reflect on profit. So what profit did our business in total produce for a year in arrears? So we prepare this at the end of the year. We talked about how we match revenues and expenses last chapter, and we can see that coming to fruition now. So I have 3 items. When should revenues count? And along with that is expenses. 2, why depreciation is important. And 3, some adjustments to some of the formulas and our income statement analysis that we have at the end. So number 1, when should revenues count? So there's a nice little blurb in the textbook about are all cash receipts revenue and are all cash outlays expenses? And the answer is a resounding no. So let's start off with when cash receipts shouldn't count. So let's say that the person who you farm with has an off-farm job, and they take money from that off-farm job and they put it into the farm or ranch business. That's not revenue. It also doesn't mean that there's no way to account for it from an accounting standpoint. If off-farm income is put into the farm checking account, we simply debit cash, let's say it's for $1,000, and credit owner's equity for $1,000. Boom, it's done. This appears on the balance sheet. These are lasting accounts, but this is not a revenue or an expense. So it doesn't show up on the income statement. Or let's say that you have an old farm truck that has, you didn't even know you had it, came with the land, it was great-grandpa's. It's an old farm truck, you're not attached to it, there's trees growing through the bed, and these pickers come and they offer you $2,000 for it. $2,000 goes into the business checking account. Again, does that count as revenue? No, because it's not part of typical daily or yearly or weekly business practices. Part of your mission statement isn't to grow old trucks out of the ground. Now, that doesn't mean that if buying and selling stuff and something that you make money on couldn't go on the income statement. If you enjoy antique tractors and you buy old antique tractors and you refurbish them and sell them for a profit, that's business revenue that should count. So money coming in should only count as revenue if it's part of normal operations. That's really it. That's the litmus test. It's not complicated. Okay, number 2, why is depreciation important? Depreciation is kind of it's something that I want you to leave this class with an appreciation for, probably the wrong word to use, something that you think about a little bit differently. Depreciation allows farmers in Section 179 to take lots of depreciation and count against income. And oftentimes they do that to shelter themselves from income taxes. But I want to make sure that you understand that just going out and buying a new equipment to not pay income taxes does come at real costs, namely depreciation. We have a hard time understanding why depreciation expense is an expense, because if we're taking it later in the life of the asset, we think, well, gosh, we've already paid for it, there's no expense. But what we're trying to do is isolate revenues and expenses in multiple years. And if we're buying an asset that's very expensive, we're not just going to use it in 1 year. While it will have cash flow implications only in the years that we're paying for it, all of the years that we're using it, we should spread the expense out. And that's what depreciation does. So go away from agriculture for a second, and I'll tell you a true story, except for the part that I have to make up at the end to prove a point. I know these 3 brothers. They are part of a huge family business in South Dakota, the most successful business of their type in South Dakota. One brother part of the business. The other two brothers, they went to film school, and they have a film business. And by my estimation, they work somewhere between 50 and 100 hours a year. Their parents are encouraging, they're nice guys. Parents are encouraging, they have leased them a building, bought all the film equipment, all the computer equipment, really set the business up well. So let's say that over the course of those 50 or 100 hours that they work every year, they actually do business. They do, I've seen it, it's pretty good. And they have cash revenues of $10,000 and cash expenses of $1,000, leaving them cash profit of $9,000. And they do this every year. They have $9,000 of cash revenue in year one, or cash profit in year one, and year two, and year three. But then in year four, they leave their equipment in the bed of their pickup and it gets rained on and it's ruined. Do they have enough money to pay for a $10,000 camera and a $10,000 computer? And I'm making these numbers up somewhat. No, they don't. Because they had not made enough money in the first few years to be able to pay for the equipment when it needed to be replaced. So we can think about the purchase of equipment. So let's just say we're buying a new tractor and we record the transaction in this way. Oops. Say our tractor is worth $200,000 and we pay for it with cash. And from the balance sheet standpoint, nothing happens. But if we do or don't use this tractor, it's going to go down in value. The tractor's got to drive enough profit to pay for the fact that it's going to harm our balance sheet by $200,000 if we never use the tractor. Another way to think about the tractor's value of $200,000 when we buy it is that it's a prepaid expense. If we think about buying like seed, we buy seed and we say, well, we're not going to use it yet. It's a prepaid expense. It's a current asset. We're going to shift it to an expense later on. That might help us understand the tractor. The tractor, it's going to depreciate, and so its value comes from the fact that we're buying an expense up front, and then as we use it, we're going to divvy it up in each successive year. Okay? There's some notes on straight line depreciation and declining balance depreciation. Just a quick note on that. Let's do a really fast problem. Let's say that our tractor has a cost of $200,000 and a salvage value of $20,000 and a useful life of 10 years. Under straight line depreciation, our annual depreciation is the same every year, $18,000 per year. How did I do that so fast? 200 minus 20 means that it's going to lose $180,000 worth of value, and I'm going to take it in equal amounts every year for 10 years. So there are some obvious advantages to straight line depreciation. Easy to use, and I think it's probably the most accurate for users that are going to use the equipment for the entirety of the 10 years and longer. Then I'm going to take the expense as long as I can, and the nice people at the IRS will tell us how long we can spread that out. And since I'm using it the same way every year, I might as well take the same amount of depreciation each year. Our other method is called declining balance. And our annual depreciation in declining balance is equal to R, which is the straight line rate, times the percent. So if we were using 150 our annual depreciation is R times the percent times book value. Right? R times the percentage times the book value. I know I'm going to AD is equal to R times my percentage times book value. R is the straight line rate. So in the case of an asset with a 10-year useful life, that rate is 0.10, times, if this is double declining balance, that would be times 200% times the book value. Now, in the case of our tractor, the book value in year 1 is $200,000 times 200,000. So I can do that math pretty fast. 0.1, double it. 0.2 times 200,000 is $40,000 of depreciation in year 1. In year 2, it's going to be 0.1 times 200% times 160,000, because my book value is cost minus accumulated depreciation. Notice that when we're calculating declining balance, we don't take salvage value into account. Instead, salvage value comes in at the end when we realize we have to fudge our numbers somewhat and shift to a straight line rate so that we can hit our depreciation on the nose. In either case, whether I'm using declining balance or straight line depreciation, I'm depreciating the same amount. In this case, it would be $180,000. That is the maximum amount that I can take in terms of depreciation. However, if I'm only going to use the asset for a short period of time, for income statement purposes, not for tax purposes, there we have to follow whatever the IRS says. For income statement purposes, declining balance will reflect the market better. Usually things like equipment and vehicles, they depreciate faster at the beginning and slower at the end. Things like buildings, probably straight line rate, fences, straight line rate. All right, thirdly and finally, interest expense. Now, depending on which book you have, when we calculate return on equity and return on assets, we are first saying you've got to include opportunity cost of family labor and management. You've got to pretend that's a real expense. So take that out of your profit. But then we add interest expense back, or we take it out depending on which version of the book that you're talking about. I'm not going to get into that because I don't think that the ratio analysis is necessarily, it's important, but it is not, we need to follow the most recent guidelines, and that's not necessarily what I'm interested in here. Instead, when we're using the income statement for profitability and we look at return on assets, for example, I have a $10 million farm and I want to know what type of profit that investment in $10 million of assets drove. If I have one farm who has a large amount of interest expense and one who has none, the farm that has lots of interest expense is going to show lower profit every year, as opposed to the one without. They don't have that expense. So if I'm comparing my operation to average, the only way to compare and say how good of a manager are you, how good was performance, was to give the interest expense back. Now, obviously you paid the interest expense, but we have to consider what would happen had you not had any interest expense. The operations would be the same and on equal footing. So we can compare the ratio. It doesn't change the actual net farm income or income from operations. Okay, hopefully you found this helpful. If you have any questions, please come to Zoom tomorrow. I'm going to add some Zoom sessions at night for people that can't come, or shift tonight for weeks 4, 5, and 3, 4, and 5 most likely. We'll iron out those details as we go. Thanks.